Oh, wait, should I take myself off stage? Because you're not on stage yet.
Sure. Yeah, I'm about to start us.
Okay. All right, bye. Welcome, guys.
Good morning, everyone, and welcome to February's Market Insights. I am Paul Nalabandian with Fulcrum Residential with Keller Williams Capital Properties, also a member of the Agent Leadership Council. And this morning, for the first time, I have the pleasure of welcoming Temi from the block, who is also from Fulcrum Residential, a wonderful colleague. She is going to collaborate on this one, help man the chat, and just make it a little more interesting and exciting, since we're not able to have the live audible interaction now that we're streaming across multiple platforms. We are going to handle that through the chat. So we'd like to get started by just having everybody drop in the chat what your one takeaway, your one aha, what you'd love to leave this morning's session knowing, talking about, covering. We'd love to get that in the chat, and we'll make sure we cover it. If there's anything, if we end up getting too many questions or comments, if we can't cover everything today, we might have a follow-up session just hitting some specific things if they come up outside the scope of what we are going to get into.
Okay, so we have from the chat, someone's asking, is the DC market actually crashing? Like, what's going on? Any other questions from you guys?
Yeah, keep them coming, please. And that is that's a good question. You'll actually see what we're covering today. We're kind of hitting the same topics we often do, but we are going to specifically delve into that. We're going to start off looking at mortgage rates, the underlying economic data that impacts those. Then we're going to look at real estate specific market data for the DMV. We're going to look at the most recently reported month, January 2025. Go back to the bigger picture, just take a quick peek at annual, quarterly, monthly data for the last year or two. And then we're going to look at a very short peek at recent Washington, D.C. data. I'm not going to go into that in as much detail today because we want to cover what was just related to in that question, kind of what's happening with the DC real estate market related to everything that's going on with the new administration in the economy. So that's after we cover the weekend absorption rates, DMV. Thank you, Tom. We're going to be covering weekend data, and then we're also going to be covering kind of more specific, what is inventory looking like in the DMV? Are people fleeing the area? Is there cause for concern? What's going on? What's important to know for our businesses and for our clients? So that'll be the last thing we touch on. I'm going to try to get to that with a little bit of time left so we can really spend some time covering that specifically. All right, so let's get started.
And Paul, there was one additional question that came in. Is the market going to correct itself sometime soon? And when do you think?
Gotcha. Okay, these are all great questions. We're going to cover that into more detail once we get to that section. So we're going to start off, as we always do, with mortgage rates. Forced audience participation. Where are mortgage rates at? What are people seeing? What do we think? Where's the 30-year? And of course, when I say where are mortgage rates at, there is no one mortgage rate. I use the 30-year reported by Mortgage News Daily. It'll vary for your individual clients, but that's why just kind of love to get input. What do people think? Where's 30 years sitting? 675. Yep. Yep, that's right around
6.7. Yeah.
Yep, that's right at where Mortgage News Daily is reported, about 6 3/4 for the 30-year. All of these rates are right around 20 to 30 bips lower than around this time last month. And a lot of that movement has come within the last 7 to 10 days. And we'll discuss in a few minutes why that is. So this is a little closer look at where we've been headed. You can see here, as of a month ago, we were a little bit higher. Over the past 7 to 10 days, like I said, we've seen kind of a steep drop. What are people seeing with their own clients? Who has locked? I see Daniel, you said 6.5. Do you have a client who's locked at 6.5 recently? I'd love to hear some actual real world where are people locking at, both for fee simple and condo. If you throw out a rate where you've had a client lock at, please let us know if it's fee simple or condo. So I'll chime in here. I just had a client lock at 6.75 for fee simple. Also had our excellent lender, Todd Petey. We love to work with him. He just quoted a condo rate of 6.625 with someone doing just 5% down. Oh, she locked at 6.35. Yeah, so yep. We're seeing right now, we're seeing real world rates that are coming in lower than what's being reported at. So 6.35 for a condo is not bad at all, particularly in light of where we have been. And so this is a situation where there is a lot of uncertainty in the DC real estate market. We're going to be talking more about that shortly, but this is great dialogue to have with buyer clients in particular who have been sitting on the sideline. What should I do? What's going on with the real estate market? And you can let them know that right now, with where mortgage rates are, they can be saving a fair amount of money from where things have been not so long ago. I mean, we saw rates in the low to mid sevens, high sevens not so long ago. If you have a movement of a point in a mortgage rate, that's about 10% in your monthly borrowing costs. So the purchase index, mortgage application volume, it usually tracks where the mortgage rates are at. We haven't yet seen data reported yet to cover this recent drop in the past week. So the last numbers I saw with the application volume was they were about steady with where they were from a week earlier. Expect when you see this week's numbers to come in, I expect to see applications go up with those rates dropping. Thank you, Summer. 6.5 on a DC condo. Yeah, so we're seeing a lot of good rates out there for our clients. It's good stuff. Okay, where are people? How are people feeling about the economy? And I'm going to cover, for anyone who's new joining us this month, in just a moment, I'm going to go into a little more detail as why I cover all of these sections of the economy that we do. But how are people feeling? What are they hearing? People worried, people not worried? Are you hearing things from your clients? I feel like oftentimes as real estate agents, we're kind of the first line of industry professionals outside of the finance sector who really hear a lot from our clients about concerns, where things are going, how the job market's doing, inflation, all of that. And so we're a great barometer of getting the pulse of the public out there. Demi just reminded me that there's a lag between what I say and when it goes to the live stream. So we're gonna wait just for a moment for people to chime in on that. Yeah, government workers are worried. I'm seeing the same thing. I'm having a fair amount of people from the government reach out. We're also seeing fear of the unknown. Yep, getting a lot of that too. Okay, just briefly before we go into the specifics, this is why we look at economic data. And you can see this flow chart here, have a little more detail in this following slide. You can take a look at when I send it out. I'm not going to cover in an extreme amount of detail right now, but basically I cover all of these things I'm about to cover between now and when we hit real estate specific data, because these are all the things that go into where mortgage rates are at right now and where they'll be going. And if you understand all of these various components, then you should have a decent idea of where mortgage rates will be trending. Now, there's a level of uncertainty in the market right now because of the somewhat dramatic changes and proposed dramatic changes of the new administration. And so market experts, industry experts, loan officers are feeling a level of uncertainty they haven't felt in a while, expecting some volatility. But knowing all of these various components still helps you understand where the market is and where it's headed. And so we're going to cover all of these individual components moving forward. Okay, now getting back to the question, what I was polling for. What are people feeling? And we have a great tool for that. Each month, the Conference Board of the National Bureau of Economic Research conducts a consumer survey. And this is a very closely watched survey. It's very well respected. And what this reports is often taken as kind of gospel, as where the pulse of the public is. Latest results of this survey were released just a couple of days ago, Tuesday of this week. And the survey is reporting that U.S. consumer confidence right now is at an 8-month low. And not only is it at an 8-month low, but it's deteriorated at its sharpest pace in 3.5 years. So where people were feeling a month ago and where they're feeling now, that's the sharpest decline they have seen in this survey in 3.5 years. And consumer sentiment has declined for 3 straight months. And consumers in the survey, it reported people are worried about inflation. People are worried about what's happening with trade, what's going to happen with tariffs, and the effects of these mass firings or intention to have mass firings, layoffs of federal employees. And this is important for us to know because this is what a lot of our clients will be feeling, even if they haven't quite communicated that to us yet. And so it's helpful to understand that and to be able to speak about it in some level of intelligent detail. And that's why we cover everything we cover here. Just here, this will be in the deck. Yeah, Ty mentioning there's locally a lot more uncertainty and unease because we do have a larger component of the labor force here from the federal government. And so we have more people impacted directly. I do say, though, that even if the general public isn't discussing these things at a level that we are locally, that's probably going to change as some of these policies are more impactful nationwide. But we are kind of the first line of defense here. So we are going to feel those things first, but a lot of these things are going to have a stronger impact nationally. Just an interesting read I have here. When you get the deck, you can click on the link. There was a story in the Wall Street Journal this week that was discussing how the U.S. economy depends more than ever on rich people and how the ultra rich are impacting the economy. I don't recall the percentage, but it was something like the top 2% of income level in the U.S. Accounts for 10% of consumer spending. And that has a lot of effects down the line. All right, now we are going into inflation specifically. So we had January CPI, most recently reported month. We're always going to be a month behind on these figures. So January CPI was up by 0.5% seasonally adjusted. Shelter drove 30% of this increase, which was lower than many past months. But this 0.5% increase was also the highest month-over-month increase we've seen in 20 months and above market expectations of 0.3%. Now, this is not great news for a couple of reasons. One is that shelter driving 30% of this increase, lower than it has been recently. So shelter costs are starting to settle in a little bit. And where experts are expecting those shelter costs to continue to decrease a little bit, but this means there are other factors driving inflation. So even though shelter is getting a little bit more manageable, these other factors are pushing inflation, meaning that we may be stuck with higher inflation for longer, or at least the current rates. And just quick note, when I mentioned shelter costs here in particular in the DMV, as real estate agents, you might be saying, what are you talking about, shelter costs coming down or shelter costs being reasonable? Because we're seeing general year-over-year appreciation in property values. And that is true. But for this index, shelter cost, it comes to basically rent equivalents set by leases. And there has been some easing up in the rental market. So quick note before we move on is that there's been a lot of movement in the stock market this week. As we talked about, we've seen mortgage rates come down rather sharply in the past 7 to 10 days. And this inflation has helped drive a little bit of the lower mortgage rates, which might sound funny. How can we have inflation, which will cause the Federal Reserve to pause their funds rates drops? How can that result in lower mortgage rates? And that's because, going back to this chart, there are a lot of factors that go into mortgage rates, but the primary driver is the bond and the mortgage-backed securities market. These inflation numbers spooked the market and caused a lot of money to flow from the stock market into the bond market. The more money there is in the bond market, the less these bonds have to pay as far as returns to sell their product. And so the less you have to offer to sell a mortgage-backed security, the lower rates you can offer on those component mortgages. Dramatically oversimplified, but in a nutshell, that's kind of what's been going on. Annual inflation numbers were 3% for the all items 12-month index. This was the highest rate since July. So inflation heading in the opposite direction of where we would like. But if you've been following along with this, with my sessions for a while, this is what we expected. With the new administration coming in, kind of all of the policies, all of the proposed policies, most of what they are planning to do was going to have inflationary pressure. And we're starting to see a little bit of that creeping in and expect to see kind of more of that going forward. We're checking to see if I missed any comments. And because there is a little bit of a lag, go ahead, Temi.
Paul, we just had someone on Instagram just say that, they're worried, people are worried about the market. So just giving feedback.
Thank you, Temi. Yeah, and that's really why, I'm going to sound like a bit of a broken record here, but understanding what is happening, why it's happening, and being as educated as we can as an industry, as a collective of real estate agents and industry professionals here. It's more important now than ever because there's so much uncertainty and you're seeing a lot of false information out there. So the more information we can provide to our clients, the more we can be the expert and help counsel them to make their decisions, the better off they'll be, and the better stewards we will be. And it's not about pushing anyone in one direction or another. It's just about providing our clients with as much information as possible so they can make informed decisions about their possibly changing lives and dramatically changing circumstances right now. All right, jumping into jobs and unemployment. And we added 143,000 jobs this past month. So it's a cooling job market, but it's still strong. So we saw many months last year adding 200,000 jobs, at least one month, and I think more than one, adding 300,000 jobs. We're dropping down from those levels. Job market's cooling off, but still, it's a fairly robust employment market, fairly robust amount of jobs. But I do want to note it was slightly below market expectations. The market expected the job market to add about 169,000 jobs. Countering that a little bit was that the job counts for November and December were upwardly revised. And I'll try to just put these little reminders, refreshers in maybe once or twice throughout the session to not overly bore the people who are with us every month. But when these numbers are announced, how they relate to market expectations is in many ways more important than what the actual numbers are, because you have a lot of money in all of these various markets. You have a lot of incredibly smart people in finance working in these industries, and they're not waiting for these numbers to be released to make their decisions that impact their businesses and their clients. They are getting ahead of the market. They're staying on top of everything that's happening, and they generally think they're going to know what will be happening before it happens. And so they're making their market decisions. So usually when you see numbers announced, jobs numbers, inflation numbers, anything like any of these big releases of economic data released, if you see quick market movement after that, it is usually because these numbers didn't match the market expectations. So the market had gone down a certain path expecting one thing to happen, something else happened, and then that's when you see the rapid movement. And that's when you start to see a little more quick movement in mortgage rates and the stock market in the various segments of the market here. So unemployment related dropped to 4% from 4.1. It had been in that band of 4.1 to 4.2 for the past 7 months. Still a relatively robust job market. And just wanted to mention, Tammy reminded me, so this session is geared towards real estate agents and industry professionals. If anyone is on here, just a regular consumer, buyer, seller, you're welcome to stay. We're not going to kick you off. We're going to be talking shop a little bit in a way that may not have as much relevance for you. But as you can see in the ticker, Tammy and I do a monthly Q&A directly targeted to consumers with burning questions you may have. So if you are on here, if you're not a real estate agent or industry professional, and you'd like to join those market sessions, those Q&A sessions, want to have a little more information about that, just message me directly. All right, going to the Federal Reserve, forced audience participation again. Would love to have you guys say when was the last Federal Reserve Open Market Committee meeting? What happened? Anything interesting going on there?
Hey, Paul, really quickly from Instagram, someone said, in Arizona, we had a noticeable drop in the completed sales in January. We know that the market slows in December and January. However, this looked more concerning. Did you experience anything similar in your market?
When you said Instagram, I switched over to my Instagram and then didn't catch everything that you just said. So sorry, can you repeat that? You said someone from Arizona was...
Yes, he said, we had a noticeable drop in completed sales in January. We know the market slows in December and January. However, this looked more concerning. Did you experience anything similar in your market? And thank you for joining us in Arizona.
Yeah, see the question there, Sunil. Good to have you on with us. So yeah, January for closed sales was actually that wasn't the case here. Closed sales in our market were very robust in January, but pendings were lower, and we'll look at that when we get into real estate specific data. But that portends a little uncertainty. So we closed out the year really strong here. But next month, the following month, may not be as strong. The real estate market may be losing a little bit of steam. So my personal opinion here is just that it's the same kind of thing that happened for different reasons in March of 2020 when the pandemic hit. There is this large thing going on that people don't entirely understand. They know there are going to be changes, possibly dramatic changes. And so it's causing some people to slow down their decisions. I know personally, I have a lot of people reaching out to me about possible actions they're taking related to what's going on. For buyers, it's more concrete. I have buyers reaching out to me saying, Paul, I've been told in a month I have to be in the office I have clients, I help them sell a condo in DC. They moved to Maine. Now they're moving back because they work on the Hill. And they used to only have to be here 2 days a week, every 2 weeks. And within a month, they're going to need to be here pretty much every day. So buyers, I'm having them like, I need to get back here now. Concrete decisions need to be made. Actions need to be made. On the seller side, I'm getting more inquiries from government workers saying, my job may be gone. I may be leaving the area. I might need to sell. I want to talk to you about that. I'd love to hear in the comments what others are getting, and just kind of keep them coming. We've already had the fear of the unknown, afraid to make moves, all of that, but we'd just love to hear more specific questions you are getting from clients. And then our resident econ expert, MBA Virginia, yes, January 28th to the 29th, getting back to the audience participation question, that is when the Federal Open Market Committee last met. They held rates steady as expected. Like I mentioned, the industry, finance, market professionals, they kind of know what's going to happen before it happens. If you follow this monthly or follow the data, you should also know that as well. Nobody expected rates to drop at this most recent meeting. Rates had dropped. The Federal Reserve had brought down the funds rate each of the last 3 meetings, but the market expectation, clear expectation, was that they would hold steady. And Federal Chair Jerome Powell said specifically after the meeting that the central bank would need to see either real progress on inflation or some kind of unexpected weakness in the labor market before considering further rate reductions. And And so just important to note, he mentioned specifically inflation or unexpected weakness in the labor market. We're seeing other sectors of the economy soften a little bit. You're definitely seeing, like I said, consumer confidence dropping. But right now, the Federal Reserve is keying in on it. It's like, listen, inflation or jobs, those are the two main drivers in what we're looking at and what is informing our decisions about rate cuts. General market expectation is that there will be 2 rate cuts throughout this year. That's less than was anticipated previously. There had been a time where we were expecting a lot more rate cuts coming out throughout this year. Right now, the market's thinking there will be 2 rate cuts. And I think the consensus, if you poll economists or industry professionals, consensus is that, or the majority thinks that that next rate cut will come at the June meeting. But there's a lot of uncertainty right now. And that's one other thing I want to add, that if you feel like you don't have a great grasp in what's happening right now with the economy or the real estate market, then there are 2 reasons for that. One, you're just not really following anything and you generally don't have a great grasp of what's going on. Or 2, you are following all of this stuff very closely and there's just a much higher level of uncertainty than normal. I've spoken with a lot of loan officers, a lot of top agents who usually have a fairly strong opinion that they know what's going to happen, and that's not the case right now. And I'm one of those people. I don't feel like I have a great idea of what is going to happen, but I know what to look for and what indicators to keep an eye on to give me a little bit of an edge as those things continue. All right, jumping into the 10-year Treasury yield. Before we move on, no shocker here. If mortgage rates are coming down, then generally 10-year Treasury is coming down. That's dropped about 0.3%. Going back to mortgage rates, I said most mortgage products have dropped by about 20 to 30 basis points since we met last month. Same thing with the Treasury yield, dropping by about that same range. Retail sales. So the advanced estimate for January, which just came out about 10-ish days ago, indicates that retail and food sales dropped by almost 1%. And so this was well below expectations of have my decimal point in the wrong place there. It was supposed to be a 0.2% decrease. That was the expectation. So retail sales dropped a lot more than expected. And there are a couple of important things to inform your assessment of what this means. So 2 things are: the December figure was rised upward from 0.4% to 0.7 of a gain. And so with more robust sales than previously reported in December, the January numbers by comparison decreased by a larger number. And so the expectations are that there wouldn't be that much of a decrease, but we also didn't know that the December figures were going to be revised upwards when a lot of that data was being formulated. And then the other thing is that, in the winter, weather affects a lot of things. If you're looking at sales or manufacturing industrial output, which we'll talk about in a moment, if you have really cold, really bad weather, that can affect things going in both directions. And so for January, the average temperature in the US in January was the lowest since 1988. And I know a lot of times I was thinking about leaving the house to do some kind of errand. And when I saw the temperature, if I didn't have to, I might have put that off a little bit. So consumer spending the same kind of way. Periods of cold can delay that. And we'll see when we talk about manufacturing, it can also cause bumps in some segments. Just want to add here, I have in my comments that this does, though, go against, there were a lot of expectations that Americans were going to be rushing out to buy goods ahead of these new anticipated tariffs. We're not seeing that at the retail level, at least. Going into manufacturing output, so we talk about industrial production. Industrial production, when you hear that, think of kind of tangible and intangible goods and services, and then a subset of that is manufacturing. So industrial production rose by about 0.5% after rising by 1% in December. This was a little above market expectations, but it would be misleading for you to see that and think that industrial production outperformed what the market was expecting, because this growth was primarily driven by a sharp increase in electric and natural gas utilities. So like I just said, retail sales, the thought in the market was that the cold weather kept retail sales down a little bit. Flip side, these industrial production numbers were inflated because of a lot more demand on these utilities in cold weather, people just needing a lot more to heat their homes. And so that 7.2% increase in electric and natural gas utilities helped have that 0.5% bump. Manufacturing output decreased by 0.1% in January. That was pulled down by the auto sector. Auto sector is a little bit weak. And so just generally, before we move on, going to industrial production as a whole, 2 straight months of gains, but the industrial sector in the US hasn't really shown much growth since 2022. So it's been relatively stagnant, not a huge driver in our economy. Speaking of the economy, we've had a couple of numbers released since we last met. We had the advanced estimate coming out for Q4 GDP. That was 2.3%. The second estimate will be coming out today. And then real GDP for 2024 was reported for the year annually over 2023, 2.8% growth. Looking forward, Federal Reserve Bank of Atlanta, they have a GDP Now model. That model is currently predicting a Q1 of 2025 GDP at 2.3%. We look back to these past couple of years, you'll see that is lower than many quarters. Another indicator that the economy is likely slowing down at least a bit. And want to note, as I have here, that so 2.3% would be a lower quarter than we just had. It would be lower than a lot of recent quarters. And the GDP Atlanta is also the GDP Now model usually runs a little higher than other trusted projections and ends up being a little bit above what the final GDP numbers are reported. Okay, we are going to move into the DMV real estate market, real estate specific data in just a minute. Taking a peek. Yeah, key things that, go ahead.
Paul, you mentioned earlier that there's a lot of uncertainty even with lenders and realtors. So I just wanted to touch base because right after you said that, you said there are key things that you look at to kind of stay ahead, right? So I just wanted to piggyback and just identify what are those key things because there are a lot of realtors on here. What are some key things that you look at to stay ahead, to not feel so uncertain?
And are you talking about economic data, real estate data, all of the above?
Real estate.
Okay, yeah. For real estate, there's a little bit of a lag in data. So there's power in the collective, power in the group. You and I happen to be on a team. We're surrounded by a lot of agents, and it is really helpful for me just to say, hey, Tammy, what are you seeing? Tom, what are you seeing? Ty, what are you seeing? Talk to our colleagues. For those of you who aren't on teams, talk to your fellow agents, go into the brokerage offices, ask them what they're seeing, because that is going to be the most recent data. Drawback of that is it's not going to be on the scale that we get from the Bright data. So other than just trying to maintain a flow of communication between me and my colleagues and my clients to get a pulse of what is happening immediately or as recently as possible, I look to primarily when the Bright releases their monthly report of data, I take a look at all of that. And then each week they release weekly data. And the weekly data from Bright is kind of the most recent, unless you're doing granular searches of data in the MLS, looking at individual markets and comparing that to what happened just using kind of manual searches. I'll also go into smart charts and look at the data from there. But within that, I'll pay attention to a lot of the stuff that we're about to go into now. And that was a perfect segue. I'll just look to see, what's happening with the days on market. Where are closed sales at? Closed sales and pending sales. So closed sales for January, we just had the question from Sunil talking about what's the market been like, what was happening in January. So closed sales in January were up, pendings were down. Well, a lot of closed sales that closed in January went under contract in December. So if we're seeing pendings down, that, might we have a softer February than we did last year? Indicators right now are yes, we are going to. And then just keep an eye on median sales price and months of inventory. So those are the primary things I'll look at. And I'll always take a quick peek at the most recently reported week, because that'll be the most recent data there. And now for people on here, what are we thinking? How are we feeling like the market is? What's been happening? How are days on market? I know I gave a lot of this away already, but what are you seeing with your clients?
As we wait for comments to come in, because of the lag, I love what you said, Paul, about making sure that you're looking at the data. Like we pay as realtors, National Association of Realtors. So the NAR stats, the Bright MLS, all the resources that you pay for, start taking a look at that data. Start looking and reaching out to your colleagues to interpret that data. One thing that I can see, that I sometimes see, is that even when we're asking our colleagues what they're seeing, sometimes it can create a tornado of negative opinions versus actual stats. And so I was at an event yesterday where I pulled up, there was an opinion given about the market, and all I did was pull up the NAR stats. And I was just like, okay, well, if we have uncertainty about the DC market, well, let's pull up what happened in January versus just giving our thoughts and opinions. And we looked at the numbers, and it calmed the table down versus just kind of talking about our opinions based off fear.
Mm-hmm. That's a great point, Temi. And we talked about that also, where you forwarded me something from TikTok that said the DC market is booming as far as listings. We're seeing all of this explosion in new listings. And that just wasn't the case. That wasn't reflected in the data. There weren't more listings. There were, in some areas, there were fewer listings than there had been at the same time last year. Since then, kind of within the past 10 days, we've seen a little bit of a change in that. And that's the last thing we're going to talk about, that it's like there very well could be some inventory increases in the DC market. A lot of these federal government layoffs and changes that are happening could impact us in a fairly dramatic way. We just don't know yet. And anybody who says they do know, I mean, if they're communicating their opinion and making that clear, that's more power to them. But if anybody's telling you they know specifically what is happening, or that something is already happening that's rather dramatic in the real estate market, that's just not the case. So yeah, great comments. Virginia mentioned stay informed, talk to your sphere, past clients, stay calm. Yeah, and Christina, that is, if we do have, we've had because of the low inventory in most of the area for quite a while, it's been a little more difficult for buyers. And if things are softening up, if we're having a little more inventory compared to demand, that does provide some good opportunities for our buyers to be able to negotiate a little bit more. All right, good stuff. So jumping ahead, median sales price. Median sales price, these are DMV wide numbers. Most of us, even if you're licensed in all three areas, you'll be helping clients who may only be looking in Arlington or Alexandria or Bethesda or DC proper. And so it's important just to know that these are DMV wide, and things can vary a fair amount when you go county by county or area by area. But DMV wide, we have seen, we're now at 20 straight months of DMV wide price appreciation. So the median sales price for homes in the DMV has now increased over the level of the prior year for 20 straight months. And that went up by 4.4%. So it's another thing, if you have buyers who are like, I'm waiting for prices to decline, there's a little more uncertainty right now, like I said, but that's a tough bet to make, because if you had been making that bet for the past year and a half, you would be losing. And the only difference between buying a year and a half ago or buying now in a lot of these markets would be you'd be paying more for your home, and the seller would be getting that equity that you could have gotten. Median days on market, we're now up to a little over 3 weeks. That has increased 3 days since January of last year. So taking a little bit longer to get homes under contract, but still 3 weeks is relatively quick for the dead of winter. And also want to say, all this stuff about weather, this affects our clients too. mean, I know, like, I'm sure there are many of you who would schedule open houses, or you'd have a new listing and you'd be all excited about the open house, and then the weather would just turn to crap and you wouldn't have many people show up. Or you have a property that might have been on the market for a little bit, weren't expecting much traffic, and all of a sudden it's like a beautiful spring type day in the 60s and you have a flood of people coming in. So same thing. I think that this weather in January did probably affect some of this buyer demand, some of these showing levels from the people who aren't motivated and needing to move immediately. All right, closed sales. Going to what I mentioned, closed sales for the DMV for us in January was up by almost 11% year over year. So we saw a big boost in closed sales, reflecting our kind of strong closing out of the year, strong closing out of the 2024 year. But keep in mind, I have been referencing 2019. Now I reference 2020 because we still haven't hit COVID yet. If we go back to this time of year in 2020, we're still at only 72% of closed sale levels for 2020. And that's something that's going to be more important when we talk about listing inventory and what's happening with our market. So new pendings, as I said, yep. Thank you, Realty Ventures. That's a great point. And that's what it's not just the federal government. There are a lot of these ancillary and related businesses that rely on federal government spending, and a lot of these contracts that are worried that their contracts are going to be ended, they're not going to be renewed, or that what's happening in the federal government is going to affect them. So totally, absolutely true, and very good point. Okay, so new pendings down 6.4% year over year. So we should see that reflected in closed sales for February. So February might be a little bit of a slower month than expected and compared to some of the recent months we've been seeing. Okay, right now, active listings are up year over year. We have a little over 6,000 active listings in the DMV, 12 straight month of DMV-wide increases in inventory. We had a year of declines. We've now had a year of increases. But again, this is still 72% of 2020 levels. So we're having more inventory relative to where we've been at, but we're not yet back to what I would consider kind of a normal market. Same thing with new listings. So new listings, this is for January, they were down 4% year over year. This is 64% of 2020 levels. So people are talking about, and so keep in mind, this is January data. We're now nearing the end of February. We're going to talk about more recent numbers in just a minute, but it's whenever you see these things like, oh, listings are up by X%, or active listings are up by X%, inventory is up by X%, it's important to tie that to a baseline number. And I'm using 2020 right now. And we're still seeing stuff that's in the 60 and 70% of these baseline levels. So we have a lot of growth to make before we're even kind of at a normal market. And I mean, my opinion is new inventory would be a good thing. We could use a lot more inventory in a lot of these areas of DC that can be absorbed by buyer demand. And there's still going to be enough buyer demand out there for sellers to have successful sales, but it's going to help some of these buyers we've had that have been looking for properties for a fair amount of time and just not finding decent options.
That's
showing level.
Sorry, I was going to say that's a really great point, Paul. I just wanted to just emphasize that point because there's a lot of conversation about increase in inventory in our market. But just a reminder that we've been staying low inventory for the last few years. Like we've had low inventory. So the expectation or the showing of increase in inventory does not automatically equal a market crash. It just, we need more inventory on the market anyway. We have such low inventory. So this is getting to be, so it's not like a market crash where now is automatically a buyer's market. We needed more inventory anyway.
Mm-hmm. Absolutely. I've been in real estate now for, where's my math, like 7-8 years, and we've had low inventory the entire time. generally, I mean, we're seeing more inventory in parts of DC. DC's about 4 months of inventory, had been up in the 5-ish range before. So we're seeing some meaningful inventory in DC, but nowhere else. Good stuff, Temi. These are numbers kind of we've already talked about. Just go into a little bit more detail there in the deck if you want to pay a close attention. Now we're going to dive in a little bit closer. Like I said, if it's good to know the DMV numbers, but since most real estate is a little more area specific, a lot of our clients, we don't necessarily have clients coming to us and saying, hey, I want to buy somewhere in DC, Maryland, or Virginia. You know, let's look at all of these places. Usually buyers are a little more specific. And then if you have a listing, clearly that's going to be more location specific. And so we're seeing a big variance here. So closed sales, in these various areas, we talked about overall closed sales for January were up by about 11%. In DC, they were up big. Closed sales in January in DC were up by almost 30%. Frederick also, closed sales up by 20%, 17% in Loudoun County. Closed sales were up everywhere, all of these component counties, except Prince George's County. A little bit of a drop. Closed sales were down 1.4% year over year. Median sales price down in Arlington, down in DC, even in Frederick, up everywhere else, consistent with what we've been seeing for a while. DC tends to have softer pricing pressure than these other areas. Most months we're seeing price appreciation in these various components, with funky stuff going on in Arlington and Alexandria, usually relating to just the breakdown of property types that have sold in that given month. Days on market, no shocker here. DC leads the area in days on market, getting properties under contract. They're at 43 days. But they're getting some companionship in that range. We're seeing a lot of areas in the 20s. Northern Virginia, Frederick, Prince George's County, they're all in the 20s for days on market. Montgomery County's at 19, Loudoun's at 15, Fairfax is 11. So properties, if you have buyers looking in Fairfax County, you better be moving quickly, because if the median days on market is 11, you can bet that a lot of homes are going under contract a lot more quickly than that. And also good to know these numbers when you're talking with your sellers and setting their expectations for I have a condo listing coming up. Appreciate the question. For lack of inventory, when you speak to who you expect buyers to be, largely investors. I expect is that we have in this area, we do have a lot of investors who are looking to purchase properties. Almost all of us as agents have people who are like investors who are, I'm looking for this. If you can find this, let me know. But the problem is, for an investor to purchase a property, it has to be at a price that makes sense in order to allow them to get a return. So your largest buyer pool is always going to be the owner occupier. And that's the case here. So that's always going to be the largest buyer pool in any segment. I mean, I'm not talking about like multi-unit properties, just talking about fee simple, row homes, detached homes, and condos. So they're always going to be kind of the owner occupiers. And I expect that to continue. And it will, the federal government does make up, they are a major employer in the area, but relative to the job market as a whole, they are not as big of a factor as they were in the past. It's not to say this won't have an impact, it will, but there's a lot of tech, there's a lot of employment and industry in this area that is driving our local job market. But yeah, federal government's still big enough of a player to have an impact. All right, gonna keep churning through these so we can get to the most recent data and talk more specifically about that, how all of these administration changes are going to be affecting things going forward. So now looking into new pendings, new listings, and showings. So this is like, expect February to be a little softer. It's new pendings are down everywhere. We talked about overall as a whole down by about 6%. Individually, they're down everywhere except DC and Montgomery County. So there's a little interesting dichotomy there if you go back. So it's median sales price in DC is down, but closed sales and new pendings are up. And so there's more buyer demand out there than we have seen, but it's still not enough to overcome some of this price depreciation we're seeing in certain areas of DC. So new pendings up also in Montgomery County by about 8%, down more than 10% though in Arlington, Fairfax, Frederick, and Prince George's County. So now getting into what we talked about inventory, new listings. New listings for January were down everywhere except Montgomery County. So in January or early February, when we hadn't had this February data from the last week or two coming in, if people are talking about this boom in inventory, what were they talking about? How can you say there's been people are fleeing the area? They're just throwing their homes up on the market for sale. When you look at every single one of these areas, other than Montgomery County, had fewer new listings than fewer new listings than there was the prior year. And that's Virginia comments that remember current data reflects consumer behavior from 3 months ago. And yeah, that is true. There is a lag in these things, and that's what we're going to talk about when we get to the end. If I were to say just in sum, what do I think is going to happen? It's kind of like we don't really know, and a lot of people they're reaching out to us now to get better informed so that they can make the decisions when they do know. Because there's just everyone I work for, the federal government for the most part, unless they've lost their jobs already, has some level of uncertainty as to either will my job be eliminated or will I intentionally, voluntarily leave because of a change in circumstances. So there are a lot of decisions to be made, and all we can do is understand the information as much as possible, know what's going on in the market, and help counsel our clients. So showing data up big in Alexandria, up a little in DC, reflecting some of the other numbers we saw, up in Frederick, down pretty much everywhere else. Just going to overall active listings, even in Loudoun, but inventory's up everywhere else, 17 to 33%. Alexandria is up even a little more by about 50%. But caveat, this is still below what a kind of normal market would be, and that's directly related to the mortgage rates. You have all of these homeowners sitting on high 2s to low 3 mortgage rates, and they just can't quite bear to bring themselves to purchase a home and have a 6 or 7% mortgage rate. So a lot of pent up inventory there. And I don't see, regardless of what goes on with the federal government, I don't see the floodgates opening on that inventory until we see a meaningful drop in mortgage rates. So months of supply, DC had the highest days on market. No shocker that it also has the highest inventory, about 3.9 months of inventory there. Everywhere else, there's no meaningful supply. If you have a month to a month and a half of supply, there's not a whole lot out there. So for buyers looking in all of these other areas outside of the core district, it's a little bit tough, slim pickings. Going to move through this pretty quickly. Home demand index, no shocker here. Home demand has started creeping up from December, but it's actually a little lower than this same time last year. And you can see the orange reflects this year, blue last year. We're pretty much even with where we were at last year. We've been tracking for the most part, see a divergence in September, started to creep back together coming into the fall and the winter. Blue means slow. This you can take a look at when you get the deck. This is just looking at where we ended up last year. We were pretty close in 2024. 2024, pretty much even with where we were at in 2023. This is your annual data, looking at quarterly, monthly. Take a closer look. I left this in the deck, DC specific data. I'm not going to cover this now, but you can take a closer look. Getting to the most recent week. So in DC, choice listings are selling high and everything else is sitting low. So, I mean, comment on that briefly before we get to the last week or two. I would say that's true in general, that choice listings are selling higher, things are sitting. It's when you have a softer market like DC, that is more true. The margin for error is smaller. You can have a wonderful property go under contract right away and other stuff sit. But it's still, I don't know if I would say selling high, because if you look at here, the median sales price year over year change in DC, every property type has dropped. So blue is all home types. Magenta, I guess you could call that detached. That's down a little bit, and then this is row homes. This is condos. So we're seeing some price depreciation throughout DC among all property types. But yeah, if you put a great property on the market, you'll have better chance of success. And we are still seeing some competitive situations where stuff gets bid up it's just much, much rarer. Okay, so now this is what I had planned to have a little more than 5 minutes to talk about this, but this is the most recent reported week from the DC area for the week ending February 23rd. And you can see that new listings are up 16% year over year. They're up 21% from 22% almost from a week ago. And so we are seeing some increase in new listings. And so that could lead you to believe that some of these changes are already having an effect on the DC market. But this is where, and like, if I don't feel like I have a good handle on what's going to happen, I'll be completely transparent on that, because there's nothing more dangerous than acting confident to our clients and telling them that you know what is going to happen, and then they make decisions based upon that inaccurate information. And there are just too many wild cards right now for anyone, I think, to have a good handle on what's going to happen in DC. Mentioned before, we all probably saw reports about a surge in listing activity, increased listings in the DMV. But when most of those articles or those social media pieces were coming out, the data just didn't support that. It just didn't support that. Through mid-February, there had been no meaningful increase in new listings. Many of these pieces were just kind of clickbait, not accurately sourced. But that could be changing. So I just mentioned the most recent week, new listings were up in the DMV by almost 16% from last year, up from last week. Overall, in the Bright footprint, we saw only a 3.6% increase year over year in new listings and a 7% uptick from a year ago. But that's still not sufficient to tell us, I don't believe, about a meaningful change in DC. And the reason I say that is I look at these weekly numbers all the time. And specifically, I just wanted to reference one. There are just so many times where you'll have DC numbers as far as new listings, active inventory, diverge from the Bright footprint. So if you go back to October, mid-October 2024, weeks before the presidential election, overall in Bright, the whole Bright footprint, new listings were up by 6.6% year over year. And DMV new listings were up by 18.4% year over year. So it's like, if you were to look at October data, that would tell you the same thing that a lot of people are gleaning from this most recent week, that it's, oh, DC new listings are up well above what's happening in the overall Bright footprint. And so that means you have these federal employees or people who are losing their jobs, rushing to sell, looking to flee the DC area. And we just don't have enough data to say that right now. And as you can see, my last point there, so DMV February new listings. So this is the weekly data. This is just from last week. This is as recent as it can be. New listings are still well below new listing levels for the same time in 2020. They're still below the level in 2021. They're below the level in 2022. They're below the level in 2023. The only thing in recent memory, the only point new listings now are higher than they were is last year. All of the other previous years, new listing level is still below kind of a normal year. And we didn't have any of any of Elon Musk and the Doge department coming in with their red pencil in 2020, 2021, 2022, 2023. So just major takeaway, too early to tell what's happening there. And the data is not reflecting kind of this wide exodus yet. All right.
I think, Paul, I feel like it's if you're just tuning into the market, it feels wild, right? So like if you haven't been paying attention to the market and you see, more listings on the market, it feels wild. But if you look at year over year, it creates a better story or different story. And so that's why things like this are so important. These conversations are so important, so that you're not just looking at what's going on right now, but like you can see it comparative to year over year.
Mm-hmm. Absolutely. Absolutely. Great point, Tammy. Yeah. If you just see a clickbait article saying that new listings are up whatever percent, it's like, okay, but they're 70% of the level in 2022, 70% of the level in 2021. We're still not kind of at this equilibrium. So yeah, yeah, another takeaway there is that inventory can come up a fair amount, and it won't be a bad thing. I'll stick around for another 30 seconds or so of lag if anyone wants to chime in with other questions. Other than that, appreciate you all joining us. Thank you, Temi. Love the interaction. And last month I felt like I was just kind of talking to myself for an hour. So it's wonderful to have your input, your expertise, and then also to represent everybody else joining us through the chat.
Paul, how can people, if someone wanted to reach out to you to ask you more questions, how can they reach you?
You can email at paul@fulcrumpg.com, or if you're joining on Instagram, you can shoot me a direct message. You can also, I believe you can shoot me a message through YouTube. Not positive on that. Probably should have a better answer.
Yeah. What's your Instagram handle for those who are just tuning in on YouTube? What's your Instagram handle?
Instagram is the same thing. Paul Knows Real Estate.
Awesome.
All right, awesome. What about Temi's also a great resource. Temi, what's your Insta handle?
It's my first and last name, so Temi Akoji. So TemiAKOJIE. I think what are some just last minute takeaways, because I feel like you touched on a lot of really great things, but if you were to kind of as I feel like a majority of the people on here are realtors, so if you were going to lead us into charge of the for the end of first quarter, what are like 3 things that you want us to keep in mind, especially as there's so much conversation and so much information around us? What are 3 things that you want us to just kind of walk away with today?
Great question. So I would say number 1, keep up on this data, keep up on what's happening. The more dramatic the changes are, the higher the level of uncertainty, the more important it is to stay informed in what's going on. Number 1. Number 2, good advice 6 months from now, 3 months from now, is going to be very similar to good advice today, 3 months ago, 6 months ago. If you're informed as to what is happening, and so let's say we do have an increase in inventory. Like I said, we're at 60 to 70% of kind of normal market levels. And so even if we have an increase in inventory, if you have someone looking to sell their property in the DMV, if you give them an accurate assessment of market value, if you put the house's best foot forward, you do all of the things that typically result in a successful sale, you're going to put them in as good a position as possible to have a successful sale, whatever the market is looking at. And so it's like the things that were important, the best practices are still important and are still the best practices. And for our buyers, you can just say, hey, good news. We are probably going to be seeing a little bit of an increase in inventory, or at least we're starting to see nibbles of that. And so that might mean you can have some more options out there. Don't necessarily expect to get a deal, because there's too much demand in this market for there to be great deals to be had, but you might be able to get that inspection contingency in, or you might be able to get some other things that you would like in the negotiation. So I would say those are my major takeaways. All right, good stuff. We're over a little bit. Gonna wrap it. Go ahead.
So one last thing, how often do you do these market insights?
Do them every month. They are typically on the 3rd Thursday. This month and last month we shifted them for last month it was the big Keller Williams conference, but 3rd Thursday of the month at 8:30 a.m. And if you subscribe to the YouTube channel, you will get a notification when I go live.
So please make sure to subscribe to Paul Knows Real Estate YouTube channel.
Thanks, Temi. Appreciate it. Thanks, everyone, for joining. Have a great rest of your day, great rest of your week.